Sridhar, MD and CEO at IndoStar, joins us on the show right now. Sridhar, we did see very good second quarter numbers, and you are a new player in the NBFC listed space. What is your outlook for the rest half of the year in terms of growth, especially in the light of recent liquidity conditions?
This liquidity crisis, which started in October beginning, has relaxed to a large extent now. Liquidity has improved week on week, and now it has improved substantially. So our business plan, we have had a 600 crore of disbursements per month, both in corporate lending as well as in retail lending. And we have done around 3,600 crores in the first half, and we are supposed to do another 3,600 crores in H2. And 1 month we had to slow down due to the liquidity crisis, but with liquidity improving now and more money is coming from mutual funds, banks and other institutions, we are restoring normalcy fully from this month. So I think in H2 also we should be on track with regard to our disbursements, and we should be able to complete our annual plan very comfortably. That's what I believe now.
Your AUM book stands at about 7,700 crore rupees, and the mix is spread between corporate lending, SME, vehicle finance as well as housing. How do you see the growth over the rest of the fiscal, and how will the asset mix shape going forward?
See, the mix between corporate and retail lending has been consistently changing. So we started off with 80% of corporate lending and 20% retail. And as of September 30, the corporate lending proportion has come down to 63 and the retail is 37. And we expect by FY20, we should have a 50-50 mix. And then over next another 2 years, we should have retail business more than 75%. That's the mix change which is likely to happen. And in the retail business, the CV financing business will be the engine, because we are operating in a niche segment of small fleet owners who are buying second-hand vehicles. So in our used vehicle financing business, we put about 70% of our total. The balance 30% is in new vehicle. The blended yield was about 15.5 till September. Now we have increased because the cost of fund has gone up. We have increased our yield in all our businesses by 100 to 150 basis point. So the vehicle finance will be the engine in the retail funding business. SME and home loans will be also grown. So we are very confident that the mix will change and the retail business will grow very fast. And no doubt that the corporate lending business will also grow, but the growth of retail business will be faster than the corporate lending business.
Right, we've seen fairly consistent improvement in the asset quality across 5 quarters, with GNPA now at 0.9 and net NPA at 0.6. What has led to this improvement, and can asset quality improve further?
I think so, because the businesses which we have been already doing is corporate lending and SME. So we don't have except one case in corporate lending, and we have few cases in SME. And in the vehicle and home loan, we don't have any NPL, because these are all businesses started in the last 1 year. So we, in the SME, we took a little more time to resolve NPL cases, as we didn't have SARFAESI approval. So fortunately, in the month of August, we have received the SARFAESI approval, and we are very confident that by March, we will bring down the NPL in the SME cases substantially. So going forward till March 2019, I do expect and hope that the gross and net NPL will come down further.
But your margins have improved sharply to 8.6 in Q2 versus 6.4. What is the margin outlook you can offer?
See, our spreads have been very comfortable. As I mentioned to you, we have been operating at a net interest margin of 8% plus in both corporate lending as well as in vehicle financing. In IndoStar, the leverage is only 2 times. Debt equity is 1:2, so the equity component is higher. So the net interest margin is higher, but the spreads are also very high in these two businesses. And after the liquidity crisis, we are anticipating cost of funds increase, and accordingly we have increased our lending rates in all our businesses by 100 to 150 basis points. So we are hoping that the spreads will continue to remain. And also in the corporate lending business, as we have been collecting upfront fees, now in the Ind AS accounting, this is also becoming deferred over a period of time. It is part of the interest income. So these are all contributing to the net interest margin. But we have always focused on these two businesses where it is 8+, and the other two businesses which are around 5+ in SME as well as in the home loans. So that is the kind of margins which we will be operating. And even when the cost of funds increase, we have been able to pass on the increased cost to the customers, and the existing portfolio will get repriced as and when the average cost of funds keep increasing.
Okay, your leverage has been at the lower end at just about 3 times. This is much lower than peers who have leveraged at least 6 times. At what level can we see leverage improve so as to improve the return on equity to shareholders as well?
We are conscious about that, and as and when the growth, we put the assets on the balance sheet, the leverage will increase. So today, because we have raised the equity very recently in May, you have a very low leverage, but this has been calculated, and we have evaluated our growth, and we wanted that capital, we have raised it, and we are very confident that next 2 to 3 years this will get consumed. And we are also developing off-balance sheet strategies. Now RBI has allowed co-lending with banks, and we can sell portfolios. All our retail businesses are generating a lot of priority sector assets. So these are all fantastic opportunities for us to develop off-balance sheet strategies to enhance the return on equity to the shareholders. So we will do all that to generate excellent return on equity over a period of time. As and when we grow our business and consume the capital, the return on equity will automatically come in.
Okay, great chatting with you. Thank you so much for taking the time out and speaking with us today.